There are 5 bank accounts that I have set up as a 6-figure business owner. First bank account is an operating business account. The operating business account is the money that's coming in and out of your business on a day-to-day basis. The second account is for payouts, even for yourself. Number 3 is going to be your taxes. You want anywhere between 20 to 25% to go into that account every single month. The 4th account's not mandatory, but I do this in my business. I have a 4th account for donations. And the 5th and final account is like a miscellaneous account. I call this a team first account.
She's not specifically calling this profit first, and maybe this idea didn't originate for her from the profit first philosophy, but this sounds a lot like what the profit first people coach is, that you have a whole bunch of bank accounts and you put different amounts of money into each one to ensure that your profits aren't disappearing on you. The problem with, I think, what she's doing is, if you just managed your business well and had good bookkeeping, you don't need 5 bank accounts. Downside of having a bunch of bank accounts is that you may end up forgetting to move money, like in your payroll account, and then payroll comes due, it comes out of the payroll account, and now it bounces, and now you have employees who didn't get paid, and now you have NSF fees and payroll fines and everything else. If you had just let your payroll come out of your main account, then as long as the business made enough to pay payroll, you're never going to bounce your payroll. But also, again, if you're keeping track of your numbers, you're looking at your profit and loss statement every month, you should know exactly where you're at without having to set it aside. Also, she said 20 to 25% take out for taxes, but what I think she means is 20 to 25% of her profit, which is a much smaller amount than 20 to 25% of whatever's in the operating account. So you've got to have a good system for tracking how much you're making and what's going on with your business anyway, just to know what amount to pull aside. So of all the accounts, I'd say one for tax savings could be a good idea if you're the kind of person who's not good at setting aside money or keeping track of how much you might owe. But it shouldn't be 20 to 25% of everything that comes in. It should be some percent of the amount that is your profit. So you still need good bookkeeping either way. And then a miscellaneous account and a donations account. I mean, if you want to make a donation, make a donation. If you want to have some team building or reinvest in the business, You don't need to put that into a separate account and then pull it back out into the business. And it all comes back to keeping good records. If you're keeping good records, you don't need any of this nonsense. And if you're not keeping good records, but you have 5 bank accounts, then you really don't know how much you need to be putting in each one anyway. You can't be very successful with one without the other. If you're going to only have one, have the bookkeeping.
Here are the top 5 write-offs for new LLC owners. Number 1, take your home office deduction, and make sure you're taking the advanced method instead of the simplified method. If you write off your square footage and you divide it by the entire square footage of your home, you can take a percentage based on the expenses that you have for running your home office. The second write-off that you should be taking is your equipment. Most business owners have laptops, iPads, and cell phones, but they're not choosing to write them off. The third write-off you should take on your tax returns is your vehicle. In order to make sure you can write off your vehicle, you need to make sure that the business is using the vehicle for more than 50% of the time for business. And if you choose to get a vehicle that weighs over 6,000 pounds, you'll be able to write off 80% in your first year on your tax return. The number 4 tax write-off you should take as an LLC owner is called the Augusta Rule. The Augusta Rule allows for you to rent your house to your corporation for 14 days rent-free. The number 5 tax write-off you should be taking as an LLC is your marketing and advertising expense. If you're a business owner and you're not spending money on ads, you're not spending money on marketing, you're leaving a lot of money on the table to grow your business while receiving a tax deduction at the same time. Many of your entrepreneur friends are on the internet, they want to be able to transact with you, but if they don't know you, they can't flow you. So make sure you're taking your marketing and your advertising expenses. Follow for more tips.
Okay, so home office, yes. Vehicle, yes, if it qualifies. Equipment, yes. Laptop, desk, chair, things you use for your business, yes. Those are just normal business expenses, and you should definitely be including them. And then marketing and advertising expense, yes. If you're spending money marketing your business, spending money on ads, that is an expense. You should be taking those. That all seems like pretty straightforward deductions that any business owner should be taking to maximize the amount that you're keeping from all your profit. Otherwise, you might be paying more in taxes than you really needed to. Number 4, though, the Augusta Rule, that is frequently thrown out as, hey, here's a great way to lower your taxes. Just have your business rent from you as the owner of your house. As long as you're renting your house less than 14 days, you don't have to declare that income as the individual whose house is being rented, but the business does get to rent it and have that rental expense reduce the profits of the business. Here's the catch, though. It has to be for a legitimate rental purpose, and it has to be at a legitimate rental rate. If you have some divey studio apartment that you're using for this, and then you say, oh, my business is going to spend $5,000 a day to rent my tiny little divey studio apartment for company events, and the company event is you and your dog collaborating on watching something on Netflix, that's not really going to work, right? You can't. Now, yes, you put it on your tax return and you send it in, it may not get audited, but if it does, you're going to have a very, very hard time defending that. And not only are they going to withdraw that deduction and then charge you the tax that would have been owed, plus penalties, plus interest, plus an accuracy-related penalty if you're just egregiously that far off, but it's going to be very difficult to defend. So if you want to use this because you legitimately are using your home for business events that people are coming to your home for, then make sure you're charging a reasonable rate for that effort. But just using this to put in large numbers and counting up 14 days and using it as a tax fraud, basically, you're playing really a risky game there because you're not going to be able to defend that in the event that, this ever gets looked at. And the IRS is obviously aware of this rule. They're aware of this tax dodge. So if they see something that just doesn't make sense with the rest of your return, they will flag it and they will call you out and they will ask you about it. And if you can't justify it with real events that happened at your house and real numbers that make sense, would somebody else rent that for that amount, you're going to regret having made that decision to try and take that, tax deduction, take advantage of that potential tax deduction. So the other four I think all make sense, but that Augusta rule, I would be careful on whether or not you use it at all, or if you use it, make sure you're using it legitimately. The farther off you are from real life, the more likely you are to get caught with that and lose it and then pay the penalties.
It took me 6 years in business before I read the book Profit First. Mm-hmm. He says exactly what you're saying. Pay yourself day one. I had, by chapter 2, I'm like, this guy is watching me over my shoulder. This is
Mike McCallum.
Mike McCallum, right? Like what he says is it's martyrdom. And I've suffered that for years. I'm like, well, I don't pay myself. And then you get spiteful, you get frustrated. Your household bills aren't getting paid. Mm-hmm. And so pay yourself day one. Figure out what that is. Use a percentage or a fixed amount. And then it grows and scales with your business over time. Because when you do that, you can now separate your personal money from your business money day one.
Okay, so this is about Profit First, and I definitely have an opinion on Profit First. My opinion is that for 99% of the people trying it, it doesn't work and doesn't help. And I say that because we have tons and tons of clients who come to us having set up Profit First bank accounts, which is the idea is you set up a bank account for your operating expenses, a bank account for setting aside money for taxes, a bank account for setting aside profit to pay yourself, a bank account for setting up and setting aside payroll, and so on. So you end up with 5 or 6 bank accounts, and you're supposed to take money into one and then break it out in transfers to each of the other accounts. And somehow the idea is that you pay yourself a portion before you pay the rest of your bills. But there's 2 big problems with that. Problem 1 is just because you have 5 bank accounts instead of 1 doesn't mean that you actually have any more profit, right? The same amount of money came in before you set this up as after. So it's not really increasing your profit. And the other problem is you have the same bills as you had before. The day before you set it up, the day after you set it up doesn't change the amount of bills you're paying. So fundamentally, you have to run your business in a way that after you've paid all your bills, there is money left over for you, and then you are setting that aside for yourself, and you're setting some aside for taxes. You don't need 5 bank accounts to make that happen. You can do it with 1 bank account and good bookkeeping. Keeping track of what's coming in and what's going out and knowing what your margins are will help you not overspend on things that you shouldn't be overspending on, and keeping track of what's going on. More bank accounts isn't going to do that. What I often see happen is people get NSF and overdraft charges because they forget to transfer money between one or the other. They transfer too much out, then they have bills to pay and they have to transfer money back. It doesn't happen in time, and then they bounce checks. So Profit First, to me, is a way of trying to organize your business and understand your numbers, but a much better, more effective way that's going to give you much better detail without risking all the overdraft charges is to have good bookkeeping. Accurate accounting will tell you how much is going out to what, and then you can start to control it. Oh, I'm paying too much in payroll. I'm paying too much in marketing. I'm not being careful here. I need to be more careful there. I need to bring more money in. I need to cut my expenses. Good accounting is what's going to tell you that, not having 5 bank accounts. Because at the end of the day, if you have a pizza and you cut it into 2 slices, or you cut it into 4 slices, or you cut it into 50 slices, you haven't made the pizza any bigger. You haven't provided any more food. You've just cut it differently. And that's what Profit First is. It's not creating more revenue, and it's not creating more profit. It's just taking your pizza and cutting it into a bunch of small pieces. But it's the same pizza, it's the same amount of food as you had when you started. And it's less helpful than just having more details to understand how your business works. So for those few people that have found this system and found it to be super helpful, like this guy, it sounds like it changed his life, it made things work better for him, it helped him get organized, great. But for the vast majority of people who hear about this and then sort of try to do it but don't really, it doesn't help, and it's not an improvement, and it doesn't make a difference. But what they have found to be really helpful is just getting more organized in their accounting and taking a little bit of time to understand their numbers, and that does make a huge difference.